Hi, everyone. This is Ben Webster, and you are joining yet another episode of the Scaling Alpha podcast. Today, I'm joined by David Kaiser, founding and managing partner and chief investment officer of Methodical Investments. David has worked at Robotti and Company for 20 plus years, where he evolved from a bottoms up fundamental research analyst into pioneering their systematic Robotti structured value strategy before founding Methodical to manage where he now manages a disciplined multi-factor small and mid-cap value fund. He is a frequent writer on institutional risk management protocols and the author of articles examining how systematic rules can remove behavioral bias from value investing. David, welcome to Scaling Alpha. Really excited to have you here.
Thank you very much. I appreciate it, Ben.
Um, well, let's to kick us off. What I always like to do at a pod is kind of give not users, excuse me, I'm speaking software language now. Actually, viewers,
Yeah.
to get kind of a bird's eye view into who you are,
Yep.
where you're from. So tell me, where were you born and raised, and go from there.
Well, I was born in New York City in 1980 and lived in the city for a while and moved up to Connecticut in 2000 when I was 12. So 1992, and been in Connecticut ever since.
Hmm.
And we're based now in northern Connecticut basically on the Mass border. Yeah.
Got it,
So
got it. Where did you go to school?
so I went to school. I got my bachelor's at Albertus Magnus in New Haven, Connecticut.
Got it. And then, after you graduated, tell us a little about your early career journey. Where were your first stops at? And
Yep.
if you learned anything important at those stops?
Yeah. So first of all, I was fortunate enough while I was still in school to uh, intern at Robotti Company,
Okay.
and at the time, it was a smaller company than it is today, and I really got to spend a lot of time with Bob Robotti, who runs the company. He's the chief investment officer, and I learned an incredible amount and really found value investing because I dabbled before and I learned some hard lessons in 99 2000
As did
with
we all.
yeah, with not a ton of money, but it grew to quite a bit and then came back to earth and
Yep.
really decided to devote myself to investing, but I hadn't found a home. And so when I found Robotti and company and worked there starting in '05, I really found the comfort of value investing and the understanding what you own, how important that is, not just where it can go, but where is it today. And that balance was very important. And I've learned just an incredible amount. I'm very thankful to have had that and have that opportunity to learn from all the great people there.
What resonated to you about value investing at that time?
What really resonated with me was in understanding and a comfort um, of what the company's worth, right? We call it intrinsic value, right? Like
Hmm.
what is company A worth? And therefore, if you have a sound understanding of that and you have a comfort with that, you're not sweating gyrations in price and market gyrations and things like that. And previously I'd read everything you could find on investing and, kind of, like I said, hadn't found a home, something I was comfortable with. And with value investing, it fit like a glove. It was just, uh, that comfort of what is it worth today? What do we do if it goes down? What do we do if it goes up? It's a focus on the numbers and the valuation, what the company's, capable of, not the external factors as much.
Tell us about Robotti and kind of why that was a good home for you. And those, I know you're still working there to some extent, but why was a good home in those early years for you?
Yeah, so Methodical's young, and we're getting off the ground. I still work at Robotti, and it's a great experience because it's a small group of people, very collaborative, and you can learn from each other. And as I mentioned, early on, I spent a lot of time with Bob,
Yeah.
and just understanding, okay, how does this work? And Bob's background is in accounting also, so the nitty gritty. What do you look at? How do you look at it? Why is this important? And it probably was a real pain because I ask a lot of questions and did over a period of time, still do. And, it's nice to be working with people where you can get those answers and really get an understanding of what you do. And, an appreciation for, conviction in what you do. That's very important. That's something I've learned.
That, fantastic. So you mentioned asking a lot of questions. Where do you think you got that from? Not every, I mean, it sounds so trite, right? Um, 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 but not everybody is humble enough to just go, I don't know. I want to learn. The best way to learn is ask questions. So did that come from your dad, your mom? Where did it come from?
So actually, I think two things. One, I was kind of an oddball in school, round peg square hole kind of thing.
Hmm.
And so, elementary school, middle school, high school were tough for me because I think about things kind of a certain way and not always the same way the teachers wanted me to think about things. And
Hmm.
so, I kind of learned that you have to advocate and you have to really ask and understand things. Maybe not the way they're being told to you, but how
Hmm.
you can understand it.
Hmm.
And also my grandfather, who passed 10 years ago at almost 97,
Wow. Lived a long,
was
good life.
he did, and he was extremely influential on both my life, but also my career, and really getting me interested in investing at a young age, and then taking me under his wing, and really not just showing me the ropes, but showing me who I could talk to. He had a network of people that I could really discuss things with and vet things with, and I don't know where I got that humility from, and I don't even know if I'm that humble, but it's just it's so important to really understand something. Um, and I think it's scary now if you look at the market and people who are investing now for the first time. It's sort of like in 98, 99, 2000, where you know you think you're a genius, and I thought I was a genius in 99, 2000. Then I realized I was
So did
not, and
I.
that humbled me. And so, um, you know asking those questions, people who've been through it, who understand how it works, the cycles and the emotion that can go, and we'll talk about, the lack, removing that, but the emotion that goes into watching prices gyrate and the market gyrate. And I mentioned my grandfather, he was 10 years old in 1929 living in New York City, and he
Hmm.
remembered the crash well. And he went from penthouse apartment. His dad owned a business to sharing a bed with his cousin, I believe. And they had a chauffeur and all those things, and that all disappeared. And, my grandfather was like, I'm never doing that again. And I'm going to understand how money works.
Hmm.
And I was very fortunate to have him teach me that, sometimes in rough ways.
Hmm.
He could be tough. I mean, he lived through the Depression. Different generation. They're tough.
Hmm.
But I am so fortunate to have had his guidance, his love, his uh, devotion to wanting me to have a better life and understand how things work. And so,
So
just,
he's one of the people who helped instill the value of questioning. So you're at Robotti,
yep.
and in our previous conversation, you'd mentioned that you've sung the praises of Robotti, but
Mhm.
you obviously at one point started questioning, like from a fundamental approach. Maybe there were some things that you wanted to do differently. How did that evolve? How did the mindset start changing?
So I'll back up and say that when I first got into investing and really wanted to learn how to do it right after the crash, the internet bubble crash, the bubble crash, I focused a lot on technology because it's something I gravitate towards.
Hmm.
Um, if you want to see if my file cabinet, no. But if you want to see the folders on my computer and how organized and my spreadsheets, all that stuff, that's how I think. It's easy for me to stay organized in a rhythm and understand things that way. And so my early thought was to use technology to take advantage of market inefficiencies in different ways. And my focus, and before I got to Robotti, was on really momentum and things like that. And so, I'd written some programs, done stuff there, and eh, again, couldn't sleep at night. And it wasn't until I found Robotti, and then it was sort of like, okay, this is different. This is qualitative. This is fundamental analysis, talking to management, that sort of thing. And I liked it, but I still had that itch.
Hmm.
And so I think one thing to point out is it's not necessarily a right or wrong, right? It's
Hmm.
a what's your flavor, what's your appetite, and what are you comfortable with? What are you good at? And I think I'm good at picking individual companies, and that went into uh, more of a process orientation. And I think that came from I did analytics being computer focused, and I was doing portfolio analytics and looking at, um, uh, how to analyze companies' portfolios using technology, right?
Hmm.
And so I'd sit down on meetings with investors and potential investors, and I realized that there are some people who have an appetite for um, understanding in aggregate kind of a process consistency and fundamental qualitative investing. You can have strong conviction, you can have really good reasons for that, but it's not necessarily what everyone looks for.
Hmm.
Some people want something that is clearly designed and oriented to uh, a process that removes that expertise as a human, right, on our emotion and bias, and that's really what got me going in 2011, starting to develop what we do now at Methodical. So again, there's a place, and there's different appetites, right?
Hmm.
And to say that qualitative, fundamental value investing doesn't have a place, I think not the case. It's
There's
just sorry.
there's there's tons of ways to generate alpha,
There's
right?
more than one way to
Yeah.
skin a cat, right?
Yep.
And
Exactly.
I don't remember where that saying came from. It's a horrible saying. Sorry to anyone who owns a cat,
Yep.
but or has a cat, I should say. But that's the way it is. And really, something else I learned is that what at Robotti is the inefficiencies of the market, and human emotion creates that, and different
Hmm.
viewpoints create that.
Yep.
And so that inefficiency allows for different things, different ideas, different approaches at different times, and to really be effective. So,
Yep. No, it makes a lot of sense. And so, 2011, you started
mhm.
developing a strategy, which I assume at Robotti culminated in the Robotti structured value SMA, right?
Yeah. So we ran that internally for about 4 years, and that was an amazing opportunity because um, you can test, you can research, you can do all those things, but to see something move in real time and really understand the why and how in real time is very different than looking at spreadsheet or back test, that sort of thing. So that was a great opportunity to really see it alive and moving, right? And
Hmm.
created a monster, and you get to see it get up and walk around, type of thing. So
Got
that
what
was
what what
very, very
what less
beneficial.
what lessons did you learn about like kind of how you originally envisioned that strategy, and then where it evolved to? Like what were the lessons along the way, and how did it evolve?
Yeah. So initially, my thought was, yeah, we can kind of, I'm using this term loosely, automate process, put a process to value investing.
Hmm.
And early on, it was more like, what are the drivers and what, metrics are important for stock picking and that sort of thing.
Hmm.
And so what I really took out of running it those years at Robotti was, um, first of all, profitability is incredibly important,
Hmm.
not just from a performance standpoint, but when you're looking at your portfolio and you're looking at the metrics, if you're looking at PE and 20% of your companies are not profitable, how do you do that? How do you evaluate effectively? And
Hmm.
so profitability became very important because we look at a lot of profitability metrics, and to be clear and transparent and understand what our portfolio really looks like, both for us and also for investors, that became very important. The idea that the aggregate portfolio is more important than the parts also came out of that. And
Hmm.
it's not that they're not good parts, but when someone invests with you, and when I'm managing the portfolio, I'm not managing five best ideas, and people aren't investing in the five best ideas. They're investing in the entire portfolio. So to
Hmm.
focus on the metrics on that level and look at the portfolio as if it were a company, I think is somewhat unique in value investing. But I think it's important for a process oriented, um, systematic, rules based approach to have that view,
Right.
and to be able to be transparent with both yourself and understand what you own, um, from certainly from a metric data, fundamental data, standpoint, but also for allocators, you're probably not their only investment. And if you're their mid cap value investment, excuse me, you're their manager, then they want to understand what you own and why you own it, and that way they can allocate effectively. And I think, going back to my early days doing portfolio analytics, that's something that came out that some people really they want to know, you're my 5% mid cap value guy. So I want to know that your 5%, that 5% is mid cap value and what I own so that I can allocate the other 45% I put to equities effectively.
Earlier in the conversation, we talked about how there's different ways to generate alpha.
Yeah.
Stats are somewhat compelling. If you take entry level investment
Hey, Ben,
analysts out of.
you got quiet for a sec.
Sorry, do you hear me better now?
Yeah, a little bit. Yeah. Sorry.
Yep. So if you take entry level analysts out of the equation,
Mm-hmm.
experience, people been doing it for a couple of years or longer, but 55 to 60% of them, sorry, I shouldn't say that. Each of them has an average between about a 55 to 60% win rate,
Mm-hmm.
meaning out of, let's say 57 out of 58 companies out of 100 that they choose to invest in actually are alpha producing. It's at the portfolio level where things end up getting messed up, which
Mm-hmm.
that comes from oftentimes selling too early, right? Or for your winners, or selling too late for your losers.
Mm-hmm.
Also, obviously weights and balancing and all that type of stuff, right? So looking at it from the perspective of, if you're just looking at the individual securities, you're missing a whole portion of what generates your alpha, right?
Mm-hmm.
And that's important. And obviously there's portfolio management, there's weights and balancing, and portfolio optimization, all that type of stuff. That's kind of the journey you're on during that 4 or 5 year period, figuring out how to look at the portfolio as a whole and how that can generate alpha as opposed to just the individual positions.
Yeah. I think that makes I think you said it perfectly, right?
Yep.
Um, and the idea that you don't overweight in any one security when you're doing it mathematically, right?
Yep.
So if you're concentrated in your book, you're talking to management, you followed the company for 5 years, you have industry expertise, that can be a plus, right? Because you understand the moving parts, the ebbs and flows, different business macro factors that affect the business, things like that. That's great. But when you're doing it purely based on the numbers and you're focusing on the portfolio, it's important to look at it the way you just said, which is, how's the portfolio going to move? How is the majority of these companies going to be impacted by market movement? What is their potential? What's the risk reward profile? And you're doing that mathematically.
Mm.
I think certainly the way that this has been designed, the way I look at things is it's it would be difficult to do on on an individual company level and be overly concentrated. And the reason I say that is, um, you know, uh, I'm sorry, I lost my train of thought. I apologize. No,
Yeah, I think the concept is if you're not looking at how those stocks play together,
right. Okay,
yeah,
I'm sorry. Yeah, yeah, sorry. So,
there could be crowding risk, there could be all these types of things that can hit you upside the head that you weren't thinking about.
and I think it's important, certainly when you're looking at the portfolio level, that you're not trying to hit the bullseye on each company, right?
Yep.
And I think if you load your arrow and you shoot it as hard as you can and you're shooting for the bullseye, there's a high potential that you miss and badly. So we really look to create a holistic portfolio in the sense that it creates the companies create a picture, again, as I mentioned, that if it was a single company, you'd be interested in it.
Mm-hmm.
And by doing that, we have good companies that have potential, good risk reward profile, and that creates a portfolio of the same. But we're not overweighting and we're not giving, these are our 5 best ideas and this is why.
Yep.
So, you know, people talk about value traps and can bad apples get in? Sure. And the numbers, the mathematics of it, the looking at the data means that if they're deteriorating, they're not going to stay in very long. And if you mentioned selling winners, if the valuation gets way ahead of it, we're not going to own it anymore.
Yep. Yep.
But that understanding, you're right, how the portfolio moves, and that's like a living thing, right? Like I think is really important.
How long did you run what's the time period in which you ran the Robotti structured value
So about
SMAs?
4 years, 15 to
From
19.
so from my understanding, after you closed that down, coronavirus hits,
Yeah.
you enter lockdown period, and you're looking inward, like, how can I improve what I'm doing? How can I improve what I built at Robotti for the structured value fund SMAs? um what what how did it evolve from when you shut that down to what you launched it at Methodical?
So I think there were two main things. I mentioned the profitability, right? We learned that running it, how important that is. And the other two things are liquidity and your risk management protocols, right?
Hmm.
COVID really made me reevaluate and think about risk, right? In a greater way than I had. It's not that it wasn't important, but in a greater way, kind of fail safe. I don't like using that term, but like, what do you do in a bad situation? How do you manage that on a portfolio level, right? We're talking about it on a portfolio level. So that's one. The other is liquidity. And I think liquidity is something that gets missed a lot when people launch strategies or think about launching a strategy, and that's implementation. And as you grow and as you gain AUM, are you able to still run the same approach, or do you have to modify it? And liquidity is something that I really thought about and gives us a really big scalability, which means investors who come in as we grow, they don't have to worry about, certainly to a much higher number, what our strategy is going to be. And we're
Hmm.
not figuring it out as we go. And that's the other thing about being methodical, being rules based and structured. Questions that come up. Well, if A happens, what do you do? And the answer is we do B, right?
Hmm.
Like, and the term I use when I talk about this is front loaded.
Hmm.
We spent years developing this strategy. And so we have comfort and conviction in the strategy and the process. And so that means if something happens, we're not having a meeting and figuring out what to do. And okay, what about company A? What about company B? What about company C? We've done that. We've spent the time to do that. As if we thought of every scenario, probably not.
Yep.
But like we have a good idea of kind of how to handle things and uh, have comfort in having an answer to that question, both for ourselves and for allocators.
That's great. I mean, in your writing, you mentioned about trying, you mentioned even a little bit earlier in the pod, taking emotion, taking anchoring, confirmation bias, narrative affection out of your decision making. Well, built, if you've already looked at different potential risk catastrophes, right?
Right.
Things that could happen in the market, you've already kind of built what do we do in those scenarios? It's already been answered. You just have to choose option
Implement.
B or C or A,
Yeah,
whatever it may be for what's happening in the market.
absolutely.
Um, Tell me a little bit about you look at risk deep in a deeper way. Um, any specifics there you can share with the viewers?
Yeah. So, we have a fundamental belief that company characteristics, valuation matters, like what you're paying matters.
Got
And
it.
and the general belief is that we don't, excuse me, value traps. Um, we want quality, we just don't want to pay any price for it, right? And so yeah, we're disciplined, but we're not searching for the bottom, right?
Hmm.
So we believe, or rock bottom, I should say. So we believe that valuation's really important, but there are also periods of time when the market doesn't care about valuation. And COVID was one of those times, right?
Yep.
You saw a dramatic drop in the market having nothing to do with fundamentals.
Yep.
And so I think one of the things that we've implemented or, thought about is the understanding that yes, valuation's important. Having a discounted portfolio with strong metrics, operating metrics, um, generally you'll do very well. But there are stress tests. There are periods in time when it's irrelevant, and we choose not to fight the market in those scenarios. That's a period when we'll go to greater cash, and I
Hmm.
think that's important, right?
Hmm.
Um, yes, your philosophy's sound. Yes, what you're doing makes sense, but the market doesn't care at all. You got to take a step back, and you're arguing with an illogical force, right? So using
Mm-hmm.
logic, hey, the portfolio is inexpensive. They're good companies. It doesn't want to hear it. It doesn't care.
Mm-hmm. So your strategy focus is pretty much entirely within the small and mid cap value universe. Are you doing
Mhm.
just U.S.?
Yeah. Well, we invest only in companies in the Russell 2500 value.
Got it. Got it. Yeah.
So
So
yeah,
there could be some
but
foreign
they're all listed
yeah,
here.
yep,
Yeah.
they're all listed here.
Vast
Exactly.
majority are U.S. companies. Yeah.
Exactly. So what about this mid segment offers a more fertile ground for what you're trying to find?
So what do we like about SMID caps? Um, we like the inefficiency. A lot
Hmm.
of the companies are undercovered, or there's big discrepancy in what the two analysts who cover it think about, or three, and um, what causes stock prices to go up. It's perception, right?
Hmm.
So uh, there's more opportunity and inefficiency for the market to think something's going to do $1 in earnings and it does $1.10, right?
Hmm.
So I think there's more potential for that. So that's one. And the other side, as we talked about, is liquidity. So I mean, small caps might be, you look at Russell 2000, let's say, might
Hmm.
be a little have a little more inefficiency, but you don't have liquidity. You can't scale it as
Hmm.
easily.
Yep.
And there's also potentially more volatility,
Yep.
right? Um, Not that you don't do well over time, but the movement in between can be potentially rougher.
Hmm. Hmm. So
So
that's why
that's
you
mid
also
caps. I'm
expand to
sorry.
mid caps. That's why you also include mid caps in what you're doing.
Yeah, yeah, exactly. And that balance, yeah.
And so in your investor letters, you've said that about 19% of the Russell 2500 value index is composed of unprofitable companies, right? So this is a value index. What does that say about how, typical investors when they invest in a Russell, they're thinking they're getting a value exposure. How does that affect how allocators allocate capital, and does
Yeah.
that give you an opportunity to provide a true value strategy to the market?
Yeah, I'll start with the back end of that question. Yeah, it absolutely does, right? And we have requirements for profitability, and what you see in our portfolio is what you get, right? And we share
Hmm.
metrics.
Hmm.
What you see is what you get. And
Hmm.
if we have a PE of 10, we have a PE of 10.
Yep.
Okay.
Yep.
You don't what you see is not what you get with the
Yep.
indices,
Yep.
because they're only showing you metrics for companies that meet those metrics.
Yep.
And that number ebbs and flows. I think that was in our last letter. We talked about roughly 20%.
Yep.
Um, but if you're investing in index, and by the way, you cannot invest directly in the Russell 2500 value, even as an ETF. They don't have an ETF for it
Oh,
right now.
interesting. Interesting.
So the 2500, yes, 2000, 3000, 1000, things like that. But the 2500 value is kind of an underlooked, or, excuse me, overlooked in terms of its opportunity, right?
Hmm.
So, but having said that, as with any indice, especially when done by market cap, and even the value, which has like a value tilt, you're
Hmm.
getting a lot of companies
Hmm.
that you wouldn't necessarily want to own, right?
Yep.
And so we think that's a good place to start. And we also think it's a good bar to compare ourselves to. Reason being that if you look at SMID cap indices, the valuation is more reasonable. It's a better comparison, right? If we compare
Yep.
ourselves to the NASDAQ right now, I mean, first of all, we're not fishing there, but second of all, it, that's an easy to say, yeah, we're a lot more expensive than the NASDAQ, right? Okay. What
Yep.
does that say?
Hmm.
Um, and so, it's important when we realize we're an alternative to buying an ETF or investing with someone else who's doing more benchmarking and that sort of thing. So it's important to have a different snapshot, a different sample, right? But as you said, it's so important to us to be transparent and to really, what you see is what you get.
That
And
makes sense.
and you just don't get that with the benchmark. And I don't think a lot of people think about it and really analyze what the benchmark does. And just to give an example, and I think we talked about this in our last letter, the Russell 2500 value through June of this year, first two quarters, first half of the year, half the performance, a little more, was from IT, and most of that was from five companies. And I believe Most of them were a PE over 200 or didn't have one. I think there was one that was a PE 29. They were all IT companies.
Mm.
So they were in the value indice, but what are they, right? And
Yeah.
and I think the term we used was like value in growth, or growth and value clothing, right?
Yep. Yep.
And so it's very important as an investor not only to understand what you're buying and what you're comparing to, but and we implore people to do this, what is your exposure with this manager?
Yep.
Right? Even if it's not me, what are you getting? What's the portfolio look like? Right? They say, okay, we're mid cap value. Well, what are they? What's their average market cap?
Yep.
What's the PE? What's the
It's
price to book?
it's
These are
it,
important things.
it's
And
inherent style drift that's being hidden.
well, that's
Yeah.
it. And
Yeah.
and I think it's very important. Not that performance isn't important, but if you're true to a strategy and that's what people are paying you for, you need to be consistent with that strategy.
Yep. Yep.
And so that's part of it. You can be good at what you do, but not in every instance, which also goes back to having run this for a while, the patience and understanding that, for example, right now, there's a lot of exuberance, right? There's a lot of focus on quality at any price.
Mm-hmm.
We're not going to excel in that environment, but we are not going to chase. We're not going to change our strategy because right now the flavor is different.
So you are definitely a rules-based strategy, and from my understanding, you are looking at 10 distinct multi-factor screens, right? Tell us a little bit about your approach, that you think are kind of the highlights that people that you feel are most important about what you're doing.
So I'll clarify that first. We run 5 distinct screens, but we run them twice. And the
Got it.
reason we
Got it.
do that is the criteria we use very often will come up with a lot of financial companies. We like low P, low price to book, high return on equity, things like that. And it's not that we don't like finance and we don't have exposure to it. It tends to be overexposed when you look at when you look at criteria like that.
Yep.
And if you buy a
So
local bank,
so crowding risk.
yeah, well,
There you
we
go.
believe in clustering, and we'll have
Oh,
sectors
you
up
will.
to 50%. We
Got it.
do, but we don't feel financial is the best place
To do it.
to be overexposed on a regular basis, to be
Got it.
exposed heavily on a regular basis, I should say.
Got it.
So we run it twice, and we also take out, we run it some real estate, some we take out pharmaceuticals and biotech, right? Earnings aren't reliable, too many
Mm,
moving parts, and
yeah.
you saw
It's too
Moderna the other
choppy.
day, right? Yeah,
Yeah.
exactly. So so things like that. So we focus on 5 criteria, but again, we run it with a little less financial and that sector being exposed the second time. So why do we run 5 different screens of multi-factors as opposed to just saying we want, okay, P cutoff, price to book, or what are the best P, price to book, etc. So it goes back to what I was saying about like hitting the bullseye versus, good companies, right? And also that holistic view that the portfolio, we want to look a certain way. Now, if we say we have a P of 10, a price to book of 1.4, let's say, and return of equity of 22%,
Mm-hmm.
right? I'm just throwing numbers out. So let's say we have that.
Mm-hmm.
And uh, does that mean every company trades at 10 times earnings? No, some will trade for less, some will trade for more. We look to have the majority of our book, closer to the median than I think most people would, right?
Yep.
Or the mean. And so when we look at it, again, we're looking at it from different angles and different types of metrics. Different metrics work at different times and for different reasons, right? So we do have a heavy focus on PE, price to book, return on equity. We look at cash flow, we look at margins, debt to equity is important to us, all these things. And so when we weight and we rank, we have an idea of we know what the most important metrics are, but ultimately that's what we want in our portfolio.
Got it.
And if you focus just on, like I said, A, B, or A, B, and C combined, let's say, and that's all you focus on, you're going to miss a lot of good companies, and then your portfolio may look very different than you think it would.
Got it.
Yeah. So
How do you detect value traps and avoid them?
that's a great question, and we get that a lot. And the answer is you can't always avoid them,
Of
right?
course. Yeah. Yeah.
So, so there are a few things. One, we have regular rebalances, and if the numbers have deteriorated and that company we loved because of the metrics, we'll just say that, right? In 2025 and 2026 is deteriorated and the valuation isn't attractive anymore, we're not going to own that company long term, right?
Got it. Got it.
That's number one. Number two is the dispersion in names, right? So if you own quite a few names, and we're generally between 50 and 80 names, I'd say.
Hmm.
Um, so we're more concentrated certainly than like the benchmark, but we're not super concentrated, and our top
Yep.
10 are usually under 40%.
Mm.
So the um, right now, uh, I'm sorry, if you look at the portfolio and the dispersion, our sector limits are 50% and our individual company limits 20%, but that would be very unusual.
Yep.
Usually it's much smaller. So by spreading it out, if you get a bad apple, it's not going to destroy the portfolio,
Yep.
and it won't be in long term. So I think that's important. And then that also goes back to what we were saying about, no, sorry.
Yeah. Makes sense. So people may classify you as a quantitative approach, right?
Sure,
But
absolutely.
it sounds to me though, and maybe I'm wrong, you're not looking at any of the typical, kind of Fama French factors that a lot of quants are going to look at. You're looking at fundamental operating metrics.
That's
Um,
correct.
I would say um, that seems more quants that are focusing on fundamentals seem a lot more rare than quants focusing on factor models in
Yeah.
this day and age.
So we're quantitative because we're not qualitative.
Yep, exactly.
And if you have to pick one, we're definitely the quantitative, right?
Yep,
By definition. But I think we focus more on being data driven and rules based
yep,
than we do, being systematic as
yep,
opposed to, quantitative like you would typically think about it. And I think we stick to the philosophy. First of all, what are you comfortable with? And we
yeah,
talked about bias. Well, I have bias towards value investing, right?
yep,
So that's what I looked at to create this. That was the framework. But obviously it's a different way of doing it. So the uh sorry, I lost my thought again.
no worries. I think ultimately it's a lot of quantitative models are they're typically going to be looking at these kind
Yeah.
of these factors, right?
Yeah. So
Which may not be as the actually fundamental performance of the company is not as highlighted as it sounds like it is important to you, right?
yeah, and so I think, like as I mentioned, value investing, that's what I'm comfortable with. So sticking with things I understand and know, and how do those work on the portfolio level, on a systematic level. That's very important. And keep it simple, stupid, right?
Yeah,
So when you're developing something and it's fundamentally based, if you start adding in technicals and moving averages and trading algorithms and things like that, how do you isolate what works, what doesn't work, and how do
yeah,
you understand over time those moving parts? And I'm
mhm,
not saying you can't do it.
yep.
It's not what I'm good at, right?
That makes that makes a lot of sense. And and I would say a lot of times in that approach, you're trying to optimize around those factors, which could have some suboptimal um, companies that get included because you're trying to optimize those factors, right?
Yeah,
And so you'd have good apples mixed with the bad apples to get a certain sector allocation, to get momentum at a certain place, to things like to get your information ratio
yeah. And I
here.
think in those instances, you're also going to be very adaptive, right?
Yep.
And if you're adaptive versus deterministic, uh, again, how do you isolate when and how it works? And when does patience come into play, saying, we have conviction what we're doing, it's a good process, we're giving exposure to X,
Mhm.
but today it's not the flavor. And well, should we do this instead and should we do that instead? And that confidence, that conviction, I think is really important. And when you have all those moving parts, when you're trying to be adaptive, and we've talked about AI and things like that. We talk about that. People ask us all the time. You know, AI is a great tool. AI can help workflow, but do I want it to determine how and when I should be doing things? Not necessarily.
Does it help you at all though in helping you understand the factors that you already believe in better, or helping you understand the interplay of those factors to create better exits, entries, what have you?
So we've used AI to kind of validate some of the things we know, but had trouble pulling out necessarily.
Mm-hmm.
Um, and we continue to work on that, just more from a being able to explain the moving parts better than changing the moving parts.
Mm-hmm.
And I think there are ways that we can over time use AI in workflow, um, but I don't see us, and I don't see us modifying dramatically or even at all really what we look at.
Yep.
And then there are questions with AI, like so when we get into the learning models, right? Is what is it looking at? What information? How does that change? If I ask it question A today and I ask question A in 6 months, is it going to give me a different answer?
Well, sometimes it'll give you a different answer the same day,
Well,
right?
there you go. So,
Depends on how
well,
complex.
exactly. So,
If it's a simple question, it does a pretty good job. But when anything that requires any complex chained reasoning, then over time that could change. I shouldn't change over time. You can get a very different
well, that's
answer
it. And we don't want to risk
five
that.
minutes later. Yep,
So,
understood.
yeah.
No, it makes sense. I think AI can accelerate learning, right? If used the right way, it can accelerate you learning about the things that you feel are the drivers of return,
Mhm.
right?
I agree.
Uh, but you
But
need to
can
do it in a controlled, systematic, and guardrailed way, or the learnings may be false.
if I had done the 15 years I put into this today, it probably wouldn't have to be. It probably would have happened a lot quicker. And I'm not saying the 15 years was,
Yeah.
but it would have. It probably would have happened quicker. But
Hmm.
I'd probably come to the same conclusions.
Yep. That makes
So,
sense. What? So what? Let's kind of close the circle here, right?
mhm,
Um, there's probably a lot of, quantitative fundamental managers out there, rules based.
mhm,
Obviously, we know there's a lot of fundamental, value managers that do focus on qualitative and quantitative. It's not that they're
mhm.
not looking at numbers and earnings and, return on equity either. But, if you were to say kind of like the elevator pitch of what makes you different. Um, um, uh, whether we're talking to from an industry perspective and a learning perspective of our viewers, right? What sets you apart, and what are you trying to build in 3, 5, 10 years at Methodical?
Okay. So, where did I come from? I came from a fundamental background. And yes, we run a quantitative strategy, but I didn't come at it from a math angle or a programming angle or anything like that. And I think that's somewhat unique. I mean, you talk to a lot of quant people and, MIT, computer science, that's not my background. And that's not probably something I'd be really good at. But I'm good at picking stocks, I think, and understand what drives performance and what's important. And I've learned that qualitatively, and then I've tested it quantitatively, right?
Hmm.
So that's a different background. And I think better or worse, it's certainly a differentiator, right? Where did I come from? How did I develop this? And most of the people who have the expertise that I do don't think about it this way.
Yep.
So you're getting a mishmash, or a combination of uh, expertise that you and way of looking at things that you probably don't find everywhere.
Yeah,
Okay,
I would say that you could still classify yourself as a fundamental manager, but
hundred percent.
that follows a rules based
Mhm.
decision making paradigm,
No, I
right?
think that makes sense. And so the other thing that I think is different from what I've seen,
Mhm.
is the level of transparency we provide.
Mhm.
And you talked about style drift and showing that we're not doing that,
Yep.
and being clear to people who invest with us or are interested in investing in us what we offer,
Mhm.
and not just in terms of like this is how we look at it, but look, the proof's in the pudding, right?
Mhm.
This is what our portfolio looks like. This is
Mhm.
what you're investing in, and I think that's important. And I can't speak to many other managers and what they do, but I would again implore people looking at a fundamental manager who says they're large cap value, small cap value, mid cap value. Well, what does your portfolio look like? What
Yep.
am I getting exposure to?
Mhm.
Do you fall in love with something and now it's 20% of your portfolio and it's a $35 billion market cap or $300 billion market cap and you're
Yep.
SMID cap,
Yep.
right? Like I want to understand that because chances are you're not my only investment.
Yep.
And I want the exposure that I'm paying you for.
Yep.
So I think that's important.
I
And
think
I think that's
from an
differentiated.
institutional allocator perspective, that's extremely important because they're looking at correlations between their managers. They're trying to avoid manager crowding risk, right?
Yeah, exactly.
At a much higher level, and they hate style drift more than anything, right?
Well, and the they talk about correlation, right? And
Mm.
you talk about it in terms of performance, you talk about it in terms of a lot of risk metrics, but we also talk about that in terms of the fundamentals, right? If
Mhm.
the portfolio trades at 10 times earnings, I'm just using one metric and being arbitrary here, but and the benchmark trades at 20 times earnings, well, there's going to be a different trajectory and it's going to be different performance, not always better,
Yep.
but you are fundamentally lower correlation to the benchmark.
Yep. That makes a lot of sense. Well, I think I would love to follow your journey and in a year to 2 years bring you back on the pod, see how I don't imagine your strategy evolved, but love to hear more about how the business has
Sure.
evolved. I learned a lot today and hopefully did our viewers, and it
Hmm.
was a real pleasure to have you.
Yeah, Ben, I really appreciate it. And, great questions and appreciate the time.
Anybody who's interested in just learning more about the way you think, where can they find your articles, your blog, your newsletter? How do they find you?
So, you can reach out directly to me at David at methodicalinvestments.com. So that's investments with an S at the end, methodicalinvestments.com. And you can go to our website, methodicalinvestments.com, which is something we're working on improving at the moment. But you can go there and, get in touch with me. Um, and Uncorrelated Magazine, which is part of Uncorrelated Alts, has
Hmm.
published two of our articles. I believe Rhode Island last year and uh, New York also last year have our articles. But I'm happy to send them to anyone who's interested.
Well, thank you so much for joining, and viewers, thank you so much for joining another episode of the Scaling Alpha podcast. Until the next one, thank you all. Bye.